Harleen Ramirez, your accounting lecturer for today, presenting one of the topic in accounting. The objective of this video is for students who are planning for a future accounting career. This is designed to explain and demonstrate one of the important topic in basic accounting. Students will find this informative, interesting, and useful in their future career. It helps to develop the knowledge and skills to understand on how accounting concepts and procedures are applied for services and merchandising businesses. So let's now start. First, we must proceed to our main topic. We must define what accounting is. It is a systematic process of identifying, recording, measuring, classifying, verifying, summarizing, interpreting, and communicating financial information. It reveals profit or loss for a given period and the value and the nature of a firm's assets, liabilities, and owner's equity.
Hi everyone, anyway, I'm Rosel. Our main topic for today is the segregation of accounts receivable. So let's define the accounts receivable. Accounts receivable are amount owed by customer for goods sold and service rendered in the normal course of business. Credit is extended. It is to be expected that a certain amount of this receivable will not to be collected. Uncollectible accounts should be anticipated, and the value of accounts receivable should be reduced by the estimate of uncollectible account. There are two general methods for accounting for uncollectible accounts. First, we will use the allowance method. Let's take a look for this illustration. There is 3% to be deducted to accounts receivable. It's a part of allowance doubtful account. Our debit is for 180,000 account receivable and our credit sales is 180,000. Our entry for finding the 3% of 180,000 is 180,000 times 3% is 5,400. This is our doubtful account expense. And then our credit is same as the doubtful account expense is 5,400. This is our allowance method for doubtful expense. 180,000 is our account receivable. Less allowance for doubtful accounts is 5,400. 180,000 minus 5,400 is 174,600. This is our end account receivable, also known as net realizable value.
I'm Jonalyn Londres, and our main topic for today is account receivable aging method. So let's define first the account receivable aging method. This account receivable aging method asks the question how much of the year-end balance of account receivable not be collected. The difference between the amount determined, uncollectible, and actual balance of the allowance for uncollectible accounts is the expense of the year. Take a look at this illustration. This is the example of aging method, the percentage of probability and collection of account receivable. So let's assume today is now November 30, 2018, and we have 5 customers. Customers A, due date on June 1, amounting of 50,000, and customer B's due date March 19, 75,000, C, February 28, 45,000, and September 3, 30,000, October 30 is 10,000. So, today is November 30, 2018. We have 5 customers. In customer A, due date on June 1, 50,000. It has past due of 6 months, 80%. And customer B, due date on March 19, 75,000. And it has past due of 8 months, also 75%. And customer C, due date on February 28, 45,000. It has past due 9 months, 70%. On customer D, due date on September 3, 30,000, 2 months, 95%. And last is the customer E is due date on October 30, 10,000 and past due on 1 month and 100%. Total of collection of account receivable should be 210,000. 2, 3, go. This is the entry of aging method of each customer. In customer A is collected 40,000 with past due of 6 months. In customer B collected 56,250 with past due of 8 months. In customer C collected 31,500 with past due of 9 months. In customer D collected 28,500 with past due of 2 months. And customer E is collected 10,000 with past due. The total collection of customer A to E is 166,250.
Now, we already know how bad debts are to be estimated by using allowance method and aging method. I hope this video will be useful, especially for accounting students.
Thank you for watching and happy learning!